Hey guys, Tony here. Welcome back to the channel. Another value investing video to share with you guys today, talking about a stock that I have in my portfolio, CVS Health Corp. And CVS, as you know, is a pharmacy company in the United States, one of the major ones, along with Walgreens, one of their major competitors. And a reminder, when we're talking about value investing, we are looking for companies that have a long history of growing profits and revenues that maybe are undergoing some temporary problems. So we're going to focus on this video about what are the problems that CVS is currently struggling with. Why is the price coming down from the recent high of almost $107 to the current price of $65.84? What is the potential downside and risks that we need to worry about if we're looking at investing in CVS over the next 3, 6, 9 months if the weakness continues? And what are the price targets going forward over the next 5 or 10 years? Let's get right into the details. CVS is a growing company. You can see the annual revenue chart here with annual revenues topping $339 billion in 2022. There are 21 stock analysts covering CVS with price targets ranging from a low of $76, an average of $97, and a high of $143 over the next 12 months. Are these realistic price targets? We're going to touch on that in just a second. I actually had a video for CVS ready to go for you guys about a week ago, and I decided it was way too focused on the financial statements, and there is plenty of other coverage on those. We'll go through the next 10Q on CVS together in November when they update their earnings. Let's talk about, though, the current issues that the company is struggling with. You can see my green, yellow, red dashboard here. There are a lot of greens, which is what we want to see when we're holding companies for the long term. But I want to focus on the yellow items because these are the issues that is driving the stock price down right now. The earnings momentum has been falling, and the current ratio, or the working capital, also I have flagged as red because it is less than 1. So let's talk about these two items here, the red and yellow. Talk about some things that are in the press that are currently happening with CVS and see if there are some opportunities to pick up CVS at current prices or cheaper for a long-term hold and some appreciation in the stock price. As I mentioned, they have very strong and consistent top-line revenue growth, as you can see from the quarterly revenue chart here, although there have been some issues with operating income going down, and you see that translating over into the stock price. That drives net income down as well as earnings per share. You can see how the operating income, net income, and earnings per share all have the same basic look on their charts. So as you're looking at CVS, you want to understand, why is the top-line revenue growing but the operating income and the earnings per share having some issues? That is why we have the earnings per share momentum flagged as yellow, because although they generally have had an upward trend in earnings per share, they are experiencing some momentary negative momentum. We need to understand that before we decide if CVS is a good investment right now or not. The first thing that I wanted to look at, obviously, was that big negative bar in Q3 of 2022. What happened there was a $5.2 billion pre-tax opioid litigation charge and a $2.5 billion pre-tax loss on assets held for sale related to Omnicare. Now, a lot of healthcare companies and pharmacies are struggling with or had to deal with the opioid litigation, and CVS now has that behind them. The other thing that jumps out at me on the income statement is, although the top line revenues are growing, the cost of that revenue and the operating expenses are also growing just as fast or faster, and that is what is currently hampering the growth of the net income and the earnings per share. As they point out here, the company is facing higher expenses related to higher medical costs in its Medicare Advantage business, lower volumes in its retail pharmacies with fewer COVID cases, and a major expansion of its Oak Street Health clinics, which will put pressure on earnings. Regarding these higher medical costs in its Medicare Advantage business, if you're not aware, CVS not only operates the pharmacies, but they also bought out health insurance company Aetna back in 2018. We'll talk about that briefly in just a second. And they are also a pharmacy benefits manager. The thing that I like is that CVS management is keenly aware of these cost problems that they have right now, and they are actively taking steps to address them, although it may take some quarters for it to play out. They announced in the quarter that just ended, and this was reflected in the Q2 earnings, a restructuring charge of $496 million and corporate layoffs of 5,000 people. Now, that is not the frontline workers at the pharmacies dealing with customers, but 5,000 corporate jobs that the company is planning to eliminate through the remainder of 2023. CVS says that they expect the plans to be substantially completed by the end of 2023 and generate more than $600 million in savings beginning in 2024. One thing that I don't want to minimize, and neither did management if you listened to the Q2 earnings call, is that they don't expect these costs, though, to dramatically decrease in the next year. If they do decrease, obviously that would give them some upside beat. We will have to wait and see, but I think you have time to be patient to do your own analysis on CVS and see what you think about it. There might be some opportunities to pick this stock up cheaper depending how the performance in the next couple quarters goes. As this article goes on to say, higher medical and business integration costs could hamper the company's earnings in 2024 and 2025, management warned. If expenses continue to stay high relative to growing revenues, then you can expect this stock price to stay flat or even go down. This is what we need to watch with CVS in the upcoming quarters. I'm going to wrap up CVS talking about the debt on the balance sheet because it is significant and I want you to understand it before you consider buying CVS. But let's talk about something that I really do like about them on the cash flow statement. The operating cash flow is just tremendous. $16 billion in 2022 in operating cash flow. Down here at the bottom, free cash flow. How much cash is left after paying all of their operating expenses and maintaining their capital assets? $13.4 billion. That is some tremendous free cash. So what are they doing with that cash? You can see here that they are paying out dividends. $2.9 billion in dividends paid out in 2022. And they are also paying back the debt. And we're going to close out talking about that debt. You can see here the last 4 years, starting with 2019, $5.3 billion in debt paid off, $5.6 billion in 2020, $9.2 billion in 2021, and $4.2 billion of their debt paid off in 2022. Let's wrap up now with the balance sheet and talk about that debt. Here at the top, we can see $16.8 billion the company has in cash and cash equivalents. Total current assets, $67 billion. Total current liabilities, $79 billion. I would prefer that the current assets be higher than the current liabilities. And that is why we have this red on the current ratio or the working capital. But when we look at the annual balance sheet back here in 2018, you can see that the long-term debt jumped. Let me scoot this up to the middle of the screen. Long-term debt jumped from $22 billion to $71 billion. That was related to the cost of their acquisition of Aetna. But as you can see, and we just saw on the cash flow statement, they are paying off a substantial portion of that debt every year. These are some of the things that you are able to do when you have a tremendous cash flow, is not only pay down your debt, billions and billions of dollars of it paid off every year, but shareholders are also being paid a dividend. The final thing that I want to close out explaining to you on the long-term debt to make sure that you understand what's going on here, as we just discussed a second ago, they have been paying down billions of dollars of that long-term debt from the Aetna acquisition years ago. But you can see here on the chart, the last 2 quarters, it has gone up. So what is going on with the long-term debt? This was in Q1 we had an increase in long-term debt from 67 billion to 73. And then in Q2, the one that they just finished, you see the long-term debt bumped up from 73 billion to 78 billion. Let me pull up these two articles. I'm not going to read them to you. I'll put the links in the video description. But the Q1 bump up in long-term debt was due to CVS acquiring Signify Health. And then in Q2, CVS closed the acquisition of Oak Street Health, adding another $5 billion of debt to complete that acquisition. And the final thing that I want to point out to you in that long-term debt is that 16.6 billion of it is long-term operating lease liabilities, which due to accounting rules get lumped into the debt category, but I don't consider that debt in the strict form of the word debt. Remember, if the market takes a downturn, pretty much every stock we are looking at is probably going to be negatively affected, although many people consider the healthcare industry to be somewhat of a defensive stock, so perhaps CVS won't be hurt as bad as some others. There is a lot of moving parts going on here. I think you have plenty of time to do your own investigation into CVS. I want you to keep an eye on the balance sheet, especially over the next couple quarters as we watch what happens with the total current assets versus the total current liabilities, and we watch how they control cost if they were successful in that. Let me know down in the comments what you think about CVS. I did take a recent entry in CVS, as you can see on the far right hand of the chart here at $66.93. A retracement under $60 would not surprise me in the coming months, so keep an eye out for that. That'd be even better buying opportunity. If it breaks under 60 though, then we'll be watching for a full retracement down to $47. So that's kind of what we're looking at going forward with CVS. Let me know your thoughts down below. Let me know if you're in CVS, if it's on your watch list, or if you absolutely hate it. That is cool too. Let me know why. I am Tony. Thank you for watching, and I will see ya on the next video.